Okay, hello and good afternoon. I welcome you to the special webinar today, how to trade the market opening of the US markets, especially for JFD brokers. Presenting this format exclusively for JFD brokers. So yeah, I'll welcome you. Main question is, can you see my screen? I just hope so. Everything should be fine. Yes, so the screen is visible. That's great. Yeah, I just found out that we have a little problem. So I have a little problem. It started in the morning with the German version of the morning meeting. Um, I wasn't capable of opening my MetaTrader 4 anymore, and where let's say I can open it, but if I open it, then the whole system here at my end just collapse. In fact, it's not a big deal, since now you'll probably ask, hey, and how do you trade then? It's not a big deal since I didn't plan to formulate any setups before the ECB on Thursday. My main focus right now, by the way, is on the currency markets, so especially on the euro, and based on the developments we've seen here in the last weeks, where especially in the commitment of traders report, market participants started to build an aggressive long position here in the euro, and based on that, here we have a good chance in the moment that there's no big surprise in terms of hawkishness from Mario Draghi on the press conference, that here euro could see some big moves, especially euro cat could see some big moves, since we also know that the Canadian dollar has a huge long exposure here, but also the Australian dollar has a well, quite good run right now. So started the week very strong, and is right now it keeps on building some momentum on the downside. As you can see, we are right now attacking the region around 150, and also here we have some divergence building, while the key level is definitely the region around 149, 149.30. And those are the two main currency pairs I'm right now looking at. And in fact, those two currency pairs, they are the currency pairs which I plan to trade them on Thursday. And equities right now are not really on my agenda. I have to be honest here. So since volatility keeps on being really low, I just want to present to you something. I just want to. Oh, by the way, I just closed the presentation, so I'll definitely show this presentation to you a little later on, since we'll nevertheless want to use here the chance to formulate a trading setup. But one second. But first of all, we need a little introduction. The good thing about this is that the US market opens in around 30 minutes from now. So it's 1 p.m. GMT, so 1:30 p.m. GMT, the US market opens. And so what we will do right now is, even though I do not plan to trade the US market opening, since the market conditions are still not in my favor, and that's one key reason, or one key fact you have to consider when trading the markets. It doesn't necessarily come into play for quantitative traders, let's call them, who are fully automized in their trading. But traders like me, who have a discretionary component in their trading, I need a certain market environment to perform well in, and that's currently definitely in all equities not the case. It has nothing to do with the U.S. markets. You can easily adapt this to the German DAX, for example, usually one of my main assets I'm trading in terms of equities. You can easily adapt this to this too. I have all in all a quite good feeling for the market. So in the morning I said, well, I have a clear tendency on the short side, a short bias in my trading, meaning that after the market opening was so weak here and around, respectively below 12,800 points, that I said, well, probably it's a good idea to be short the DAX here. And in fact, the DAX dropped lower and is right now attacking the region around 12,700 points. But nevertheless, I'm still not feeling really good here. Same thing, by the way, on Friday on the upside, there was the break above 12,700 points. The unfortunate thing here was, that was, by the way, one of the reasons why you could look for this region here. or why this current region is very interesting. There's a gap which was opened here on Friday, and which wasn't closed on Friday, but from there DAX went up. The DAX went up and then pushed to new all-time highs, closed this gap today. And I was, in fact, willing to take the long side. The only problem was I somehow hoped that we would open around 12,700 points, probably slightly below that level, not above it. And if we open above it, then at least we're going to see a gap close from there and move long from here. Fortunately, nothing of this happened. But in fact, the DAX just pushed higher. So all in all, the feeling is still there. Nevertheless, I don't feel really comfortable trading the DAX respective of the equities in the current market conditions. But now let's come to the US markets. Let's come to the Dow Jones here, coming down a little from its all-time highs last week. So when we pushed above 21,200 points, or we can also have a look here at the S&P. Probably S&P is a little better here since. And this is something I want to show to you, since there are two very attractive charts, very interesting charts in terms of the volatility here. By the way, here you can find those retweets in my Twitter account. I really like those charts here, and that's one of the reasons I retweeted. I could easily look it up myself, but the charts I'm looking at then are not even not even close as nice as those charts here, and before we start to analyze those graphics, let's go here to Bloomberg, and now let's have a look at the VIX. Here, let's go. Okay, so in fact, as you can see here with the European markets showing some weakness, obviously volatility comes back a little, and the volatility index here on the S&P 500, the VIX, is pushing higher from here up to, yeah, currently 10.5. But if you look at this on a yearly basis, you can clearly see that this is by far one of the least volatile market environments in 1 year. And so if you look at this, then you can see something really interesting. So here with Friday's VIX close, that was below 10, by the way. The volatility index has closed below 10 in this phase here. And it's the seventh. It's the 7 times. It's now 7. I'm sorry. It's now 7 times that the volatility index has closed below 10 in this phase. And so obviously, it doesn't happen that often, but, and this is the thing, so many people are probably asking, hey, why don't we go aggressively short now? Why don't we bet on the VIX spiking up, respectively, markets coming heavily down? Since it's mostly underinsured, and all we need is a trigger. We don't know where this trigger might come from, but just going short. I mean, and then rather sooner than later, market has to correct. I mean, there are plenty of reasons. Let's take Qatar right now, for example. It's a great reason to be short the markets. Look at what's happening in Japanese yen right now. Look at what's going on in gold. So if everything was fine, the Japanese yen wouldn't be that strong. So pushing over 100 pips here on the downside, dollar Japanese yen. And this is one of the most traded currency pairs in the world. So very deep market, and such moves are really big moves. Look at gold. Look how aggressively gold pushes towards, and right now slightly above, the yearly highs here. So there's a clear risk-off move, which is obviously not really finding some fundament here or some momentum in equity markets. But equities are, well, they are weak. Yes, we dropped below 12,700 points, but all in all, we are still quite strong. I mean, we've seen different days in equities. If it was the DAX, if it was Dow Jones, if it was the S&P, and when markets are really selling off sharply, well, you really see that, okay? And the market is really coming down massively then under those conditions here. And this is something you can definitely not see right now. While the VIX is still trading here in a region which is ridiculously low, trading around 10, slightly higher compared to the close from Friday, but still really low. And if you now look at this here, well, this is what you can get if you put the if you keep on those lines here in the chart, and then you put in the S&P in blue here, S&P 500. And what you can see is Even if those signs of the market being really calm here are something worth watching, and definitely something which is not fine at all and could result in a bigger and sharper sell-off rather sooner than later, well, we are still um, capable of moving higher without seeing any big risk-off moves. So the last time we've seen this here was in 2007. That was okay. That was the time from somewhere onwards then when during July, August, market came down aggressively, but nevertheless they stabilized into the yearly close and then went aggressively down in 2008. Look at what happened here in 1994. That was, or was definitely somewhere around or shortly before the so-called tequila crisis with Mexico here back then. But what you can see is if you look from this, if you step back 3-4 steps here, you can definitely see what markets are not necessarily doomed to fail from here and will fall off a cliff. Rather sooner or later, there will be definitely some kind of volatility coming into the market. Probably we don't see it, but right now, and even if there's some feeling you might have in your gut and saying, well, why not going aggressively short here? I don't like this idea at all. So I think this way myself. So it's not that you're alone, but nevertheless, somehow it just doesn't feel right now. And so that's one of the reasons why right now this market environment is probably too calm to be true. On the other hand, you shouldn't fight it, and you just should go with the trend. Even though we have to say that even though this market environment is probably and therefore let's go to the S&P. That's a little clearer structure. That's nevertheless a market environment where market pushed quite aggressively higher, made new all-time highs, pushed above 2,400 points. And that was, by the way, without any big drop or pullback here after these rumors around the impeachment from Donald Trump. That was on the 17th of May. Market went higher from there. And right now we're in a so-called area. We should call it the distribution area. So the distribution area is a region where the risk reward for long engagements is getting more and more unattractive. That's one of the reasons why I definitely favor short engagements here from these from this region, and could imagine to be could imagine to be attractive to look for intraday short engagements. That's, by the way, something we'll build a chart ourselves several seconds after I'm done here with my thoughts and where we stand right now. Since, as already said at the beginning, the MetaTrader right now doesn't work the way it should. So if I start a MetaTrader right now, I've probably forced a system collapse here at my end, and the webinar will stop. That's something we should avoid. So so if you look at this from here, I'll give you another example of what I'm talking about. So probably you're looking at the chart right now and you just don't get what I'm talking about, even though it's something unspectacular, let's call it. So what's the sequence here? So we have higher highs and higher lows. So that's truly something we can see here. So okay, we broke out of such an area here, consolidation area, but all in all, it's the sequence of higher highs and higher lows. And if you go to the, let's say, hourly chart here, that's probably even better. You can definitely see it. So here from there, it's higher highs, higher lows, consolidation, still higher highs, higher lows. And now the market is obviously coming down a little, probably, and also since risk reward is getting unattractive, since the higher we run here, the more unattractive it gets to go long. So what you usually try is you'll try to buy this area here. This is a so-called accumulation area. And then you try, once the market breaks above new highs here, you'll try to sell what you accumulated little more downwards here. So let's do this in green. Okay, so here, this is the so-called accumulation area, and then go for the distribution area where you keep where you sell what you just bought here. And this is usually how professionals build their trading. So you have higher highs and higher lows. Once the market retraces, you'll keep on, you start to buy into retracement. And then once the market breaks to new highs, you start to distribute what you just bought here. You distribute it to those people who just found out, oh, the market broke out to new highs here. So to a region where they finally found out, okay, well, yeah, that's great. So have a look at another great invention, by the way, JFD just announced. So you might have heard it. If not, well, then be sure that rather sooner than later you become a client from JFD Brokers. So JFD Brokers just got the license here to offer Bitcoin trading. So Bitcoin today with new all-time highs here, obviously pushing aggressively higher from here. This is like, if you're looking for a parabolic chart or something, just take Bitcoins right now. Yeah, it's crazy. It's crazy. Everyone is pushing here. And now the question is, would you start buying here in this area? I mean, there are plenty of reasons. You probably wouldn't have bought here, and it's a disaster since the market nearly doubled from there. Okay, same thing here. But what you will probably try to build a position into a more aggressive retracement here. And the main reason is since the market is already really long. And one of the reasons Bitcoins are pushing that higher here, and many people are looking at Bitcoins, are because Bitcoins are not really liquid right now. So compared to penny stocks or something where they are liquid, but such moves here are usually moves of pure greed, and which can easily be seen in market environments where not many market participants are in the market, or where low liquidity is a big problem, big topic here. And in this case here, such a parabolic rise in Bitcoins in this case, so BTC USD, is something you should definitely be really careful about. So even though it looks as if you should buy now, and in the moment we're hitting 5,000 from here right now, well, I have to say, okay, well, it was a pity that we didn't buy here. But all in all, usually, and if you have a clear, clean structure of higher highs and higher lows, you usually do not buy the break to new highs, but you usually start to sell the amount you just bought here in this area, so the accumulation area. So now let's come back to the S&P here. So if you look at the S&P, we can clearly see that the market did exactly that right now. So the market obviously pushed to new highs, and now the question is, do you really want to buy those highs? I'm not sure whether there will be a bigger move down now, a bigger corrective move. I mean, look at this here. So the market pushed aggressively higher. That was in December, for example. Nothing happened after that. Okay, that was Christmas. Nothing really happened. But look at what happened at the beginning of the year. Nothing happened. Market makes new highs, no bigger move down. Market is making new highs, not looking back here any second. Then, okay, wow, finally we've seen a pullback here. But look at how much the market went up from here. So it's nearly it's at least 5%, if not more. And this is a huge move, even for intraday traders from a risk-reward perspective. But nevertheless, I think you get my point. I don't like to buy such breaks to new highs, to all-time highs, and especially not after the market not really showing that it wants to keep on pushing higher, but it's right now topping out a little, probably because of the situation around Qatar, whatever. So the thing is, you probably should be really careful right now to buy into this move here. But probably we should look for intraday short engagements and work with a take profit on the downside. Probably we're betting on the retest of the highs here before we went higher. That was the region around 2,415, probably a little lower, 2,405 probably what we should look for. And from a risk reward perspective, I bet that this is really attractive. And we should take into account here that here in this case, so it's the daily chart, now you have the hourly chart. What we want to do is we want to trade on an intraday basis, which means we are looking for setups in the 5-minute time frame. And what we are then looking for is where do we stand here in terms of our direct dominator, which is the 1-hour chart. So, and you look here at those highs, which were quite obvious that it's a significant region. So the downside target here should lie around 2,415 points for an intraday setup. If not, if you do not plan to trade against the current momentum here, well, this is completely fine too. Since then, you wait for a pullback to happen in this region. And if the market stabilizes here, you try to position aggressively long against those highs. To be capable of formulating a trading setup, well, you should look for an anti-cyclical short based on the fact that the market is pushing towards this so-called Wirkungsbereich in German. It's distribution area where the risk reward is getting unattractive for those who are trading the bigger time frames, and that's why the natural demand will rather sooner than later diminish more and more and more and more. The market will then come down. So what we will now do is we'll have a look here at the 5-minute time frame, and now we have to see whether. By the way, I'll take out this this simple moving average here, and now what we want to do, what we have to do is we'll have to. 1 second, where is it? Here, it's a vertical line. So, and we have to. Okay, that's not so good. Doesn't matter. So we have to put it here. These are German times, by the way. So don't be surprised to see 15:30 right now here. So this is at 15:30 is 1:30 p.m. GMT, and it's a second. I'm looking. Well, what's 1 second? I look for this one here. So it's the 5th. It's from yesterday. And why do I do this? Oh, by the way, 1 sec. Here I have to duplicate it. It doesn't work. Okay, so then I'll do it that way. I copy it. So why do I do this? What do I do here? So you can see it's 10. It's in fact it's 10. It's 8 p.m. GMT. So what I have here in this interval is I have the market from yesterday, and it's the spot market. Okay, so it's the spot market, and this is what I look for. Why do I look for this? This has something to do with the fact that this is the region when you should and can expect the volume to be the highest, and that's why breakouts, for example, are more significant than they usually are in a market environment here, which is really thin. And now you have the day from yesterday and you have the day from today. You have to adapt it to your time zone here, but all in all, it's the spot market. And now what I'll do here is I'll fill in some so-called horizontal lines, and those lines, they show the high, the low from yesterday, and that's what's interesting for me. So 1 second, where is it? Here. So okay. 1 second. I want this one. No, I want this one. And now you can see here that here's the low. And by the way, I'm sorry. What we'll do here, I mean, definitely makes sense, but what makes even more sense is where is it? Here is the S&P. So it's JFD brokers. Perfect. That's awesome. That's great. Okay, so and you have the low here from yesterday. That's great. No, this doesn't work too. Oh my god. Okay, it's not a big deal, but it's a little. It's not so great. So I don't know what's going on here. Probably has something to do with the bank holiday here in Germany, and the fact that probably. Okay, 1 second. So now everything takes a little longer. I could have prepared this, by the way. Could have prepared this before, but the thing is that I just want to show you how I built my chart so that you have an idea of what I'm talking about and why do I do the what do I do here to show you what I'm looking at. And how do I look at this? So what I do have here, this will be the first tick at 1:30 p.m. GMT. That will be the spot open. And what we have here with this blue line now, and this is deeper blue, this will be the close from last Friday. So I'm sorry, not from Friday, from yesterday. So that's something we have here. So, and now this is in fact what I'm looking at right now. So to formulate my trading setup, we have to wait a little. This is something I have to add here. But now what are we looking at is we have the trading day yesterday. So these are these two gray lines. We have the trading day today. We haven't started the trading day, so we have to wait another 3 minutes. Then we have 1 p.m. at 1:30 p.m. GMT. And from here, we'll then we'll then try to formulate a trading setup. So in fact, what I'm right now looking at is the following. What you could easily do is you could work with something. I can't show it to you right now, based on the fact that the MetaTrader is not working the way it should. But okay, you could have the breakout indicator, and based on that, you have the open range, the so-called open range. What's the open range? In fact, the open range is this. So the open range is defined or defines the range between 1:30 p.m. and 2:15 p.m. GMT. And then you trade the break of the open range in direction of the identified advantage. So where is the current identified advantage? You might say, hey, wait. Aren't we in a long environment? So if you scroll into this chart, I'll just do it that way. So isn't it that here in this market environment, we should look for long engagements? Yes, this is something which is definitely true. But, and here comes the so-called or my so-called discretionary touch. The discretionary touch is like you say, well, you have an extended mode on the upside, and that's one of the reasons why you're looking for short engagements here. So that's one of the reasons why I showed to you this chart. To you, it might look somehow weird that we are now planning to sell in this region, but based on the fact that the market just headed to higher highs here and is trading in the region of the so-called distribution area, this is one of the reasons why you're looking for short engagements. And what I can do right now is I can now, or I'll try to formulate a setup which will then try to profit from from the current market conditions in which we are trading. And in fact, the great thing is, as you can see here, we are trading below this green line. This is the low from the spot market yesterday. So meaning that the moment we are opening between below this green line, we are seeing a true gap compared to the spot open from yesterday. And those gaps, in those cases, probably in the current market environment, they have probably a higher chance of getting closed. By the way, I just saved it just to be safe here. 1 second. So now I look for another horizontal line. It's here, and there we have to put it there. So as you can see, this is the first tick of this current red candle, or current candle here of the market opening. So, well, what will we do now? It's very easy. So it's the 5 minute. 1 second. I'll do the following. I'll just snap this. I'm gonna snipe it, and I'll just put it here. So no, let's do it that way. So I'll have okay, let's have the red. It's the 5 min SPX. Okay, so it's the 5 min SPX. By the way, you might wonder, last time we had we had the Dow Jones. In fact, it doesn't matter if we're looking at the S&P or in the Dow Jones or something. The setup itself can be easily adapted to every index, like the DAX or the Bund future, for example. Also, it's a treasury market. You can easily adapt this. And by the way, if you have a highly liquid and deep stock, for example, like Google or Microsoft, you can also test whether this works or not. So now what we are looking at is the following. We look at this current environment, and now what we want to see is probably a gap close and then going short from here. So if the market now comes in a little stronger and pushes higher, probably we push even a little higher from here, and we'll try to see a retest of the region of the close from yesterday at 8 p.m. GMT, but somewhere between 433, I'm sorry, and 435.36, somewhere in there we have a clear so-called and classic short trigger. And by the way, we can easily put the stop here above this red line. These are the highs from yesterday, so you don't want to be long anymore above those highs. And then you can easily formulate an intraday trading setup based on the current market conditions. So S&P 500 open range breakout short setup. This is the setup you could look for. It's 2,430, 435. 46, I said, right? And it's, sorry, this is the right number. So somewhere in here, put the stop at 440. So the risk is somewhere between 4 to 7 points. And then what's the target? What did we say? We said that we are looking to trade the S&P down towards those highs here in this region. So this is the region you're looking for here. That's the region around 2,414. And in fact, that's it. So 2,415. You have a target of something between a target which delivers a chance here between 18 to 21 points, giving you a risk reward which is at least one second, is it the right way? The risk reward, no, I think I have to put it that way, right? So in Germany, we call it Chance-Risiko-Verhältnis. So it's the reward first and then the risk. So if it's bigger than, but in this case, it's risk reward, it has to be lower. Min 1 to 2. And this is the setup I formulate here based on the current market conditions. And in fact, it takes some patience here, but you clearly yeah, you clearly have a clear setup, which is completely fine considering the current market conditions. So yeah, I'm just seeing here a question. It's how about GBP USD? So in fact, it's probably a very interesting currency in general, pound sterling, right before the election here, with Theresa May and the Conservatives against the Labour Party. And after those terrorist attacks here in Manchester and in London. But now the thing is, I have to say, even though it looks very spectacular and exciting, and in fact, probably we could easily formulate a trading setup for all pound crosses, by the way, not just GBP USD, but also GBP Swiss franc, GBP Singapore dollar, for example. So I could give you a setup here, or I could give you several setups on pound sterling crosses, which have, from a seasonal perspective, a very attractive environment right now. So from a seasonal perspective, GBP is right now reaching a very profitable and very positive seasonal pattern here, meaning that GBP from a seasonal perspective should be considered long in nearly all crosses. But the thing is that right now the gap here between conservatives and labor is diminishing, as seen as I've, or it's closing, it's nearing, the gap is getting closer here, and I think there is definitely a good reason to doubt that in this case the conservatives around Theresa May will have a clear majority after the election, bringing her in a very favorable spot in terms of the Brexit negotiations, meaning that I personally say there's a good chance that if Labour and Conservatives are both doing fine in those elections, then there's no clear majority, probably Conservatives winning with some percentage points. But all in all, there's no clear majority that this could lead to a huge drop in GBP. So mainly due to the fact that here, that was the day, and it's a 4-hour chart here. So that was the day, the 18th of April, when Theresa May called for a snap election. So meaning that in this moment here, it was clear that the market was expecting to Theresa May and the Conservatives coming out way ahead of this election, and not just coming way ahead of this election here, but also having a very favorable situation, a very favorable position in terms of the Brexit negotiations. So after the market now topping out, and after the sentiment extreme, which had built, which market participants built here, especially in pound sterling futures, around this time, now coming down to a more normal level, so normalizing here, I have to say that I see a big chance that even though we have, from a seasonal perspective, bullish pound sterling ahead of us here in the upcoming weeks, I consider GBP to be, let's say, not that attractive. So not just because, to me, it's more like gambling, going long or going short. Doesn't matter, by the way, GBP here. But it's kind of form of gambling, in my opinion, since you don't really know what this election will bring us here. And that's one of the reasons why I'm stepping back from all pound sterling crosses, even though, for example, and this is, by the way, not GBP USD, but GBP Swiss franc, for example, is a currency pair I'm definitely closely watching. Why? Well, GBP Swiss franc has a positive role. So we know that the Bank of England is really aggressive in their monetary or in the easing. So they just cut rates last year. I think it was in in August, if I remember right, when they cut rates here to 25 basis points. But in Swiss franc, or in Switzerland, you have negative interest rates, meaning that even here with such a low interest, you're still getting money for holding a GBP Swiss franc position. And so you have time. And GBP Swiss franc comes into a bullish cycle here from the 8th of June, which will then take around 12 days, I think. So we have around 12 days in which on average GBP Swiss franc makes more than, or around 250 pips over the last the last 20 years, 25 years, 22 years, I think, exactly. So all in all, GBP Swiss franc is very attractive also from a currency, what's the word for this? Carry trade perspective. Even though I have to say, if you look at the hourly chart, we're clearly bearish. So falling highs, falling lows. As long as we trade below 25.30, 25.50, I'm not willing to go long GBP Swiss franc. Even though from seasonal perspective, it's attractive to be long GBP Swiss franc. But yeah. And with the election around the corner, I'm definitely no real big fan of GBP or pound sterling being long here against any currency. So I hope that this answers the question. I'm somewhere a little sorry that I can't formulate an attractive trading setup here. But yeah, let's come back to the S&P. Let's see how it does. So 10 minutes after the open, what do we see? We see the market stabilizing here, so making it more likely that the market is probably about to to be willing to show us a gap trade, so, or a gap close. It's, by the way, another setup you could easily formulate. I'm not really willing to be too aggressive here, but what you could also do is go long from here, 2,428, go long market, and then you could easily put a stop here. It's the so-called ATR stop. It's the average true range. So, by the way, I don't, or I'll leave it here. But nevertheless, you can ignore the RSI in this context here. So it's not really interesting. Sometimes I have it here in the chart to have a better view of is there a divergence forming or something. But so right here, we are right now, really? We have an ATR of 0.85, so it's 1 point, no joke. Wow, this is crazy. Yeah, I mean, okay, on the other hand, that's like volatility is horrible right now. So, but as already said, so market long from here, 2,428, stop, let's say 3 points. Is it enough? Probably it is. Yeah, why not? 2,425. And then go for a gap close here, which is still very attractive. If you look at the fact that such a gap close here has a chance of 5 points, meaning if you're going for 5 points, having a risk of 3, you're having a risk reward of 1.67 or 1.7 if you round it to 1, which is or 1 to 1.7, which is still quite attractive, I think. So that's another idea, but this is really aggressive. So I consider this setup here already quite aggressive, but I'm not sure about the gap close trade. It's even more aggressive. Even though, I mean, well, if you wait for such a retest to happen, gap close trading idea is still not the worst idea, right? So yeah, that's it. So any other questions? There are. If not, that's the thing. So that's what trading, especially if you have a plan, is about. So wait and see, be patient. And that's, by the way, something, I mean, I could, yeah, I don't know. What shall I say? What we wait for is a test of this region. So that's all we have to wait now. And then we place our order here. We have to stop here. And then from here, we wait whether the market will push lower or not. So, and just in case you just went long, 2,428, great thing, since now you're ahead 2 points. And the thing is, the moment the market pushes higher to 2,431, you earned your initial risk 3 points based on the ATR, which is then putting us in the position to say, okay, we can put the stop at break even, since we yeah, we made our initial risk. So yeah, we just, by the way, happening right now. So another 0.25%, 0.25 points higher. Yeah, any other questions? So do you guys have any other questions? Else, in fact, I can't say anything more than let's see whether this setup works out or not. So next week, there will be another live trading event of the market opening at exactly this time. So now stop break even for the gap close trade, by the way. So the gap close, the aggressive gap close trade. I just formulate the idea. So I didn't write it down or something, but you can listen to the recording of the webinar. So 2 minutes ago or something. Please refresh the chart. Okay, I don't know. So isn't there update here? 1 second. So what do you mean by this? Refresh the chart? I'm not sure. So usually you should see the candle building up some momentum here, don't you? Yes, no? So what I just want to finish with my what I want to say is I only see the gray screen. Which gray screen? Okay, now I'm a little irritated. Which gray screen are you talking about? So in my case, if I can just show you what I see. So that's what I see. So, oh, by the way, I'm sorry, this is not so great now. So, but I have the screen here on the other side, and what I can say is that here everything's fine, and the chart here on the left looks as the chart here on the right. So I have two screens here. Short instrument 1 min without short candles. Okay, so I don't know if I get this right. So I'll just refresh it. Let's see. Now it doesn't work anymore. Okay, 1 second. I'll just open the chart again. So nevertheless, I finished my sentence. So what we'll do is then next week see if this setup played out or not. So I definitely look forward to it, and remind me to have a look whether this trade worked out or not. So there we go. It's better now. I just hope so. Okay, so yeah, that's it from my end. Nothing more. If there are any or no more questions, I'd say, well, then just let's see whether the setup plays out or not. As already said, trading most of the time is a game of patience, and wait for the setup to be triggered. The setup here, once again, this is the setup we just formulated. Let's see whether it works out or not. This is the painted version of this. So we wait for a push toward this green, respectively, the blue line, going short somewhere in between those two lines here. The green line showing the low from yesterday, and the blue line showing the close from yesterday, 8 p.m. GMT. And yeah, entry short 433, 436, somewhere in between here. We have a stop above the highs from yesterday, 4 to 7 points higher. This is the red line. And then we go with a target, we go short with a target around 2,415 points. So something between 18 to 21 points. The risk reward is minimum 1 to 2 here. And yeah, so that's it from my end. I just hope you enjoyed the show, and then let's see if this setup plays out, and talk again to you then next week around the same time. So 2 p.m. UK time, with the US market opening next week then. And yeah, so that's it from my end. If you have any questions around JFD brokers, just shoot me an email, contact me via Twitter. I'll be there for you. It would be a pleasure to have the chance to answer your questions. And yeah, so that's it from my end. Happy trading. Watch your stops, and talk to you again then next week. Look forward to it. See you, and bye-bye.